A very good evening. Hi everyone, welcome to today's session with FSM1's education series. And thank you for spending your today's time, evening today, for this session. And the topic for today is that we'll be talking about how you can get started to invest in the US and Hong Kong ETFs from RM100 ringgit per month. All right. So how the entire session will be structured is that the seminar will be for 45 minutes, and at the end of the session, there will be a 15 minutes Q&A session. So if you have any questions, feel free to type into the Q&A box, and I'll be answering the question at the end of the session. And maybe some of the questions might be answered along the way during the presentation. All right. With that said, let's get started. So first thing first is that disclaimer that the presentation today will be solely on educational purposes only. This is not an investment advice, and all investments should be done with due diligence and your own research. Okay, so before we get started and get into the agenda, right, I'll just launch a quick poll to all audiences today. If you can see now, there are two questions in the poll. One is that, do you know what is an ETF, and have you invested in ETFs? So that question will be popping up on your screen. Just you might very quickly type in the answers so I can get an overview of what's the audience like today. Right, I can see that most of you know that what is an ETF, but we have a 50-50 of that not being invested in ETFs yet. Oh yeah, now we have more people that it's not invested in ETFs, and majority of you know what is an ETF. Okay, I'll just give it a couple of seconds for everyone to answer the poll. Right. Those who have not answered yet, you can see that there will be a screen that pops out on your Zoom session, and just click on the button yes or no for the two questions. All right, thank you so much everyone for answering. So here, based on the results, I can see that around 78% say that yes, you know what is an ETF, and around 36% say that you have not invested. Okay, that's interesting. So majority knows what is an ETF, but you have not started investing in ETFs yet. So you're actually in the right session today. And at the end of the session, we will actually have a solution for you where you can actually get started even today to start investing in ETFs. So briefly on what we're going to cover, it's that why we should be investing in the first place. What are ETFs? So I believe that most of you would have known what is an ETF, but just for those beginners who have no idea what is an ETF, so we'll just quickly touch on what is an ETF, how you can use an ETF to actually structure a long-term portfolio, and at the end of the day, it's that what is the solution that FSM1 has for you that you can make use of. All right, so let's get started. So why invest, right? So this is actually a report done by the Employee Provident Fund, EPF, KWSP, that says that Malaysians, we need to be a millionaire to retire comfortably. So being a millionaire, it's no longer a necessity, but it's a need for everyone in order to have a comfortable retirement. So meaning to say that, let's say we retire by the age of 60, and for the based on the life expectancy, average life expectancy for the next 20 years of our retirement age, we need at least $1 million to ride through that years. But at the same time, only 18%, according to EPF's survey, found that only 18% have 1,000 ringgit a month for 20 years post-retirement. So this 1,000 ringgit, even though it's a bit different from the millionaire, the 1 million, right? That is the very bare minimum that someone needs to retire. So ask yourself this question, right? Even nowadays in this current situation, right? Is 1,000 ringgit a month enough, let alone 20 years down the road, right? So when you say that $1 million, when we retire, that's around 4,000 ringgit per month. That's just to actually get by, not factoring inflations and other stuffs, right? So knowing that, what are the ways that generally, traditionally, that we could actually build our nest eggs for our retirement, right? So the most clear cut for most of us as working adults, or you have your own business doing self-contribution, will be through APF, because it's a forced saving. And generally, as the years goes by, we might have also bought some properties. But at the same time, to remember that a property that we are staying in, right, does not technically fund our retirement, because if we don't actually sell the property or cash out the property, then that property still stays as a home for us, like a roof under us, but it does not generate a cash for us. So what it means is that it's not only a property that you're staying, but also a investment property that you have that you can actually cash out to fund your retirement. And the last is that what other tools that you can actually use to build your nest egg, right? Then the most straightforward and way will be actually to do investments, right? There are a couple of ways, there are a few things that you can do, but the most straightforward ways is to actually through investments. So I'll just let you to have a look at this chart, right? So over here, yeah, it could be a bit complicated, but let me just make it easier for you. This is a survey done in the US, but let's just tie down how we can actually use it in our lives. For a middle income, a majority of the assets, you can see that the net worth from 0 to 471K, it's tied to the principal residence. That's the one that we went through earlier, right? The main house for residence, the pension accounts, that's similar to our KWSP, and also some liquid assets. But to be in the actually $1 million category of net worth, what's important is that you can see that the residential property and also the pension account makes up half of it. The other half is actually through ownership of business equity and other real estates, and also in stocks and mutual fund and trust. So these two, by the time that we're in mid-career, we would have actually accumulated that and by retirement. But what that we need to actually work on next is that the second half of it, of investing either through ownership of business, starting our own businesses, or actually owning stocks through investments, which is kind of like part ownership of a business when you make investments. So that is the goal of the third leg of actually finding an instrument that can be used to grow your retirement. And in this sense, we can actually use ETF as a solution to actually build that, right? But then knowing this, right, I mean, this is something that we all know, we have read about it, we have friends and who have been there, done that. So we know that investing is important, but what's stopping us from doing it? Okay, just let me ask you that, whether this sounds very similar to what you have actually went through. So number one is the lack of resources. So some of us might think that maybe that I only have like 1,000 ringgit per month, and I don't think that 1,000 ringgit actually makes a difference to actually to build my nest egg. Maybe it's lack of knowledge. Like there's just so much of information there. Like some says that there'll be a recession coming. Some says that it's not the best time to invest now. But then when I want to invest and I want to find the best stocks to invest, and I don't know and how to analyze companies and all that. And the worst is that fear of failure. So you might have actually started to invest. You might have invested in stocks or unit trusts or some other investment instruments, and they could have been in negative the past couple of years. And that might actually could stop you from starting and get started to invest. So that's holding you back. All these are very common. You're not alone. I've been through this. Many of us have been through this. But at the same time, that this should not actually stop us from getting into investment. But what makes it worse is that when we actually go and Google, right, like what to invest, what stocks to buy, then Google gives us this sort of answers that says that, okay, 10 best stocks to buy now. And what happens is that when you go and buy those 10 so-called best stocks, and the next day it goes up a bit, and after that it comes down a lot. And then it's like, oh no, what happened? All right, and then you go into those who are more visual, you go into YouTube, and then you check out YouTube videos, and then you see some of your favorite influencers on YouTube giving out some stock tips or investment tips, and you actually follow that. Sometimes it works, but what will be more confusing is that like one video will say that, okay, buy these 5 stocks, and the other say that exact the opposite of this, that but don't buy these 5 stocks. So what do you do now? Like, do I buy or do I not buy? So is it good to go in now or not to go in now? So it's just when that's too much of information out there, and we don't know what to do, it becomes analysis paralysis, and we just stop doing anything. And even when we take action, oftentimes it actually doesn't turn out to be well. And then to illustrate this, right, this is actually a data that is pulled from eToro, a broker, stock broker, that you can see here how to look at this data, this chart, this histogram is that on the left over here, this is all negative. And on the right over here, it's positive. So what you can see is that a majority of people who have actually traded or invested, 79.5% of them actually lost money, those on this part of the histogram. And at the median return, it's 12-month returns is about -3.6. That being said is that only one small percentage of people who actually spend time to learn about trading and investing actually make it in the game, but the majority of us don't do it. And we having full-time jobs, full-time businesses to take care of businesses and jobs, and after that you have to come back and take care of families. So when do we actually get time to actually go through the market outlook and stocks of companies and at the same time take action to do it? So is there a better way that we can actually participate and be part of the market and at the same time grow our wealth and also not to miss out and do it, right? So this is where actually I'd like to introduce on ETFs, where ETF could actually help you. If you don't have time to actually look at individual stocks, to pick stocks, to look at the market, look at market outlooks and all that, you just want to be good in what you do in your job, in your businesses and focus on that. But at the same time, you're assured that you have a nest egg that's growing there no matter what, then I would suggest that to use ETFs. So what are ETFs then? So ETF actually, it's an acronym that stands for Exchange Traded Funds, right? So what it means by exchange traded funds. So as the word is self-explanatory, exchange means is that it's a stock exchange, means that this particular instrument is traded on a stock exchange. For example, here, like the New York Stock Exchange, the NASDAQ, or the Hong Kong Stock Exchange. And the word traded, it means that it's being traded like a stock. Means that, for example, if let's say an Apple, a stock of Apple, where people is traded on an exchange, where people could actually buy and sell like a stock. And the last word, funds. So funds, it means is that it's a basket of investment product, or in other words, what we can say that collective investment schemes, whereby it is not one particular stock. An ETF consists of many stocks, or in this, I mean, I wouldn't say just stocks, as the term says is that it's collective investment schemes. It could be stocks or other products, but it's actually a basket of them put together. Okay. So if, let me just go deeper in that to illustrate this, right? So I believe that most of us, and also being FSM1's Fund Supermart's customer, that you are aware what is an unit trust. So what a unit trust is very much similar in ETF, in the sense that it consists of many companies that is being picked by the fund manager to create a fund whereby a pool of people actually contribute to that fund, and this fund is being managed by an active fund manager. So that is how ETF is similar to a fund, but it's actually different from a unit trust in the sense that it behaves like a stock, whereby it's actually traded on an exchange where you can actually buy and sell that particular ETF. Okay, so both a unit trust and also an ETF actually gives you a diversified and low cost way to invest, right? But what's difference is that of how it's actually being structured. So one, it's actually being managed by a fund manager who picks and chooses what are the stocks to be in that particular unit trust, whereas an ETF actually follows an index. It tracks an index, and it's listed on a stock exchange where it could be traded. Okay, and ETF could be actually something that is quite new to Malaysians, because only of the past couple of years that we have seen ETFs and Bursa, our local stock exchange, have listed ETFs, so it's getting popularity among Malaysians. But this particular product has been in the market for more than 20 years. And as you can see, these are the biggest players or issuers in the ETF, namely being Vanguard, iShares, Fidelity, State Street's Invesco, BlackRock, and collectively they manage, as of last year, around $38 trillion of funds worldwide. So it's not something that's new. It has been in the market, and it's actually it has a fund under management of in the trillions of dollars. Okay, the reason that we're actually hearing more of ETFs now as Malaysians is that because of the availability of it being local Malaysia listed ETFs, and also available of foreign listed ETFs for Malaysians. So it's much more easier compared to a couple of years ago for Malaysians to actually get access to the ETF market. All right. So how actually ETF managed is that, again, there are two ways actually. One is the majority of the ETFs are actually passively managed, and some are actively managed. So what it means by passively managed is that technically an ETF, most of the time, they actually aim to replicate an index. For example, the S&P 500 index. And usually it's lower cost. Whereas some ETFs are actually actively managed, very much similar to a unit trust, whereby there will be a fund manager, a portfolio manager, who actively picks and chooses what type of stocks that should be in that particular ETF. And due to that active managing of that particular ETF, then there will be higher cost to manage that ETF. Okay. So a keyword here, what makes ETF so much more different, the way it's structured compared to a unit trust, is that it's passively managed, most of the ETFs. It means is that it just tracks an index fund. Sorry, let me rephrase that again. It tracks an index. So what it means by index, tracking an index, right? So you could actually, you'd have seen this concept of index when you look at unit trust, right? When unit trust says that, okay, this is their performance and they actually beat the underperform or overperform a benchmark. And usually index is used to benchmark. So what are then indexes? So here's an example of an index. So this is the S&P 500 index. This is an index that's created by Standard & Poor's. And what it does is that it measures the index of what, like the name says, right? The largest by market cap, largest 500 companies by market cap that's listed in the US stock exchange. Okay. So indirectly, this index actually tracks what the largest 500 stock markets that's listed in the US stock exchange. So let's say you want to buy, you're not interested in picking any individual stocks. You just want to just follow the index and just buy the stocks according to the index. But the thing is that you cannot actually buy an index, because the index is actually like a tool that tracks based on what it is designed to track. And that's why you can see that this is the numbers that you see here on the index. They actually no dollar signs because it's just a measurement tool. But in order for you to track an index, that is where an ETF comes in, where we use the tool that's called ETF. For example, in this case, the Vanguard 500 Index Fund ETF, or the ticker symbol, which is VOO. So what it does is that it tracks the index, but now you can actually buy or sell this particular ETF. Okay, as you can see that the movement of the chart, it's actually very much similar. So if you want to own the S&P 500 index, the instrument that you use to own the S&P 500 index is buying an ETF that tracks that particular index. So in this case, for S&P 500, one of the ETF that you could use is the VOO ETF. Now, having said that, these are actually some of the examples of the ETFs and the index that they track, the common ones, the famous ones. So we have, besides the S&P 500, we have the QQQ ETF that tracks the Nasdaq 100 index. And then that's also the JQAA, JP Morgan US Quality, which tracks the JP Morgan US Quality Index. So as you can see that these indexes are actually created by those, could be an index, that could be the issue itself, also those that makes the index. And in locally, for example, in Malaysia, we have the FTSE Bursa KLCI ETF, which tracks the KLCI index, which is the top 30 companies that's listed on the Malaysian stock market. And also the Hang Seng, the Tracker Fund of Hong Kong ETF that tracks the Hang Seng index. So just give you an idea how it actually works. So an ETF actually tracks an index usually. And besides that, there are actually a couple of types of ETFs. I'll just quickly go through. The most common one are the stock index ETFs. These are the ETFs that actually tracks the broad markets. So like we have seen earlier, right? The S&P 500 index or the Nasdaq index. So ETF that tracks those. There are also ETFs that tracks certain specific industries. So they could be either the technology industry, the financials industry, or the consumer staples or discretionary industries. And there are some indexes, some ETFs that track certain countries. like in the Hong Kong and also the Malaysia. And there are also ETFs that tracks for fixed income, could be bonds or fixed deposits or US treasuries. Commodities ETFs that tracks oil prices, gold, silver. Currency ETFs that invest or tracks the price of the global major currencies, that USD, Japanese yen. REITs, and these are the common one that tracks that. And then there are some specialty ETFs or ETFs that does a different function for it. So namely, there are three of them, which are the leverage ETFs, inverse, and smart betas. So what it means by that is that, for example, right, let's take the leveraged ETFs. So as the word suggests, leverage means you're actually making something to be more than what it is. So in this sense, right, let's say the S&P 500 index goes up by 1%. So if you have actually invested in a leveraged ETF that tracks the S&P 500, then maybe by 2x, then when the S&P 500 goes up by 1%, then the leveraged ETF goes up by 2%. But you have to remember also the reverse, the opposite is also true. If it goes down by 1%, then the leveraged ETF will go down by 2%. Okay. Whereas the inverse ETF, as the name also suggests, is that it does the opposite of what actually the index is doing. If the S&P 500 index goes up by 1%, the inverse ETFs actually goes down by 1%. And the smart beta ETFs mainly, remember earlier we went through that they actually passively managed ETFs and also actively managed. So the smart beta ETFs are actually those actively managed ETFs that are designed by the portfolio managers to in certain specific rules that aims to outperform any benchmark ETFs. So that is a general overview of the basic ETFs that we have. But for today's discussion, we'll just focus on the stock ETFs and sector industry ETFs that we'll be going through that. And next is that pros and cons, right? I mean, what is so great about investing in ETFs? Before we go to the cost and others, I'll say that the most important, that's not in my slide, it's that pros of investing in an ETF, it's actually because of the way that it's being structured. It's actually passively managed. Means that there's no active fund managers that's managing it. It just follows the whatever underlying index that it's tracking, which actually then goes to our next point. That's why it has a very low cost, usually between 0.3% to 1%. And at the same time, it gives you instant diversification just by buying one ETF of VOO. You have instant access to the top 500 companies by market cap that's listed on the US stock market. And since it's actually traded on a stock exchange, then it gives you the accessibility and flexibility to actually trade it. That means to buy and sell it anytime. And at the same time, it gives you the transparency because now you actually know what are the underlying holdings of that ETFs. It says that it's S&P 500. And as the name says, it's the 500 companies. And you actually can know what are the top 500 companies. But at the same time, there are some cons to it. It's actually a wonderful instrument, but there's nothing. There are always two sides of a coin to any investment instruments. The main one here is that ETF actually does not perform well in all markets. So ETF, it's actually a very good tool if you're investing in efficient markets. It means that the market has all the information that it needs to decide to price an equity that it has. But in inefficient markets, usually like in emerging markets in developing countries where there's not enough information, and then ETF might not be a good instrument for you to do that, because then it's not easy to actually get alpha. So I'll give you an example. It's that if you have actually invested in the KLCI ETF or the ETF that tracks the KLCI, then you would have been your ETF, your investment would have been actually negative compared to if you have actually bought some Malaysia-focused unit trust, right? It also goes back to how the ETF actually represents the economy of the country itself. Next is like closure of ETF. It's just like an instrument. There's a risk to that. And here it's that as the ETF actually only tracks the benchmark index, like I've mentioned earlier, right? Usually the indexes are used to benchmark against other instruments. So you just get the market returns. But At the same time, if the market returns are okay, then why not? And not the last 2 points is that, and I'll say that this is a very, very important point here to remember. It's that ETF itself, it's a diversified product. When you buy one ETF, for example, the S&P 500, you have already access to more than 500 companies just by buying one ETFs. But in this case, if you buy, let's say 5, 6, 7, 8 ETFs, then you would have actually indirectly owning thousands of companies. And that actually makes it worse. I will say that it's diversification because you're too diversified. Well, in good part, it's that when the market is down, when there's a drawdown, then your drawdown is limited. But when there's an upside to the market, then you don't actually get to enjoy those upsides. So your investments will be just moderate. So you can't actually make use of the growth in the market. And of course, the last is limited control in the sense that when you buy 500, you don't have actually any control what is actually being held in that particular ETF compared to you actually buying stocks yourself, right? So now knowing that of all this information that we have on ETFs, right? So we know that first thing is that we have to invest, that it's for the long term to grow our wealth, and ETF could be actually a good solution for it. And how then can we actually use this particular instrument to build a portfolio, right? So again, at FSM1, we always emphasize that we always have a portfolio of whichever instrument that we are using. And the next key term is that for long-term investments. So here we're not advocating of trading, of buying and selling for short terms, but actually keeping it for a long term. So, and the first thing to know about that is that to understand how to actually read an ETF's fact sheet. So if you take up any ETFs, there are many information that you can actually gather from that, but the fact sheet of that ETF. But these are some key information that you need to know about an ETF, right? So again, go back to our example for tonight, which is the Vanguard 500 Index Fund with the ticker symbol of VOO, which tracks the S&P 500 index. So the thing that you have to know is that what's the ticker symbol of an ETF? What's the full name of the ETF? Usually the name of the ETF is self-explanatory. Vanguard, it's actually the issuer. Remember earlier we went through, we saw that Vanguard, iShares, BlackRock, State Street, these are the top providers, issuers of ETF. 500 index funds, as the name suggests, it's that it tracks the S&P 500. What is the underlying instrument in it? So it's equity of US large cap. How does it do it? It passively manages it by just mirroring the S&P 500 index. Okay. Date of inception, yeah, it's 2010. So it's actually been there for a very long time. Expense ratio, this is important. Average spread. So average spread is that what is the difference between when you're buying and selling it. Asset under management, it's that how big is the size of the ETF, the volume that's being traded daily, number of holdings, and distribution yield. So here, the important part is that to know what is the name of the ETF, what actually it does, what is the expense ratio, and also distribution yield. If you are into distributions, then it's important. But if you're just looking at just investing and growing, then that's fine. So these are the general information that you'll be looking. And how you can actually get this information, it's that from our FSM1 website. When you just type in the ticker symbol, here again, the ticker symbol is VOO of an ETF, then this page pops up. And in the main page itself, you can see that what the investment, what that particular ETF aims to do, what is the index that it's tracking. You can get this information. And over here, you can see that the underlying index. Next is that just now we went overview page, and then we just jump over through the investment information. Then we can see the expense ratio, how often the dividend is distributed. And this is just a brief history of how much and when the dividends were distributed. And this is an overview of the performance. They are after 1 year, they actually analyze. So to give you an understanding, it's that, let's say it says that 10-year, 12.7%, and annualized, that's if you can compare, right, just have a comparison, and our KWSP gives around 5 to 6% per annum. So this is kind of like double than that of 12.7%. But this is based on past growth. And the last page is actually the top 25 holdings. So yeah, as there are actually more than 25, but these are just the top 25 holdings that is in that particular ETF. And in this case, it's VOO. So in a dashboard, in a snapshot way, you can actually get all this information just by going into FSM1's website, and you can get this. Besides that, what are the factors that you need to consider? Just to recap, is that tracking difference. An ETF, as we said, is that it tracks an underlying index. So you need the smaller the difference is, the better. That means the better that it tracks that index. Expense ratio, the lower, the better. And liquidity means that how easily is it for you to buy and sell actually this particular ETF. The spread, the smaller, better. And what are the underlying assets, and also the concentration of those holdings. Why this is important is that if certain sectors or certain stocks are actually over-concentrated, and the movement of that stock could actually fluctuate the performance of that ETF itself. And the style of it, whether it's passively or actively managed. Naturally, those that's passively managed will have a lower expense ratio compared to the actively managed one. And lastly is dividend. If your goal is actually, you're looking for dividends, right? And some of the sources that you can actually use, websites that you can use to do your research is, number one is fsm1.com. And we have gone through earlier just now. Just go to this magnifying glass over here, type in the ticker symbol, and you can actually get to that page, and you can actually see the different information that's there. ETF.com, it's a very good website where you can actually compare between two different ETFs in similar categories, similar sectors, and ETFDB. Okay, so now, once you have done all this, right, so we have actually understood that what are ETFs, where we can actually find information on ETFs. And then now we go into the exciting part of investing by using ETFs. Remember that ETF is actually a tool, but before we actually invest into an ETF, right, it's very important that we form an investment thesis. And this is not only for ETFs, this is applicable across to any investment instruments that you're using, that always start with forming an investment thesis. So what it means by forming an investment thesis is that, number one is that having an investment goal. Okay, for example, let's say you like to go to Penang. There are many ways that you can go to Penang. So you can actually take a flight, take a bus, take a train, or drive down, take a Grab, right? So those goals actually depends on how fast do you want to get there, what is your budget, and what are the experiences that you're looking for. Maybe you just want to chill and take the train ride, right? And once you have decided on which method, way of going, let's say you decided to take a flight, then goes to the next question of which flight. Like, do you want to fly by AirAsia, Firefly, MAS, or Malindo? Okay, so then this also goes to, like, you check on what's the time like and what's the price like, are there any sales, right? So when you have a goal, then it's easier to actually pick an instrument. So same thing comes to here. It's like, what is your goal? So here we have already earlier set up that our goal is actually find a third method of actually growing our nest egg. Our time horizon is long, the next 5 to 10 or 15 years even. And it's not like immediately we're actually cashing out. This is for the retirement fund. So that's the goal. And then next is that finding the tool. So the tool is that something that I can do it passively, which has a low expense ratio, that I don't have to focus too much monitoring it. So I can just set it up and focus on my work or business. Then that's when we identify the tool here. And to be more specific here, in this example, I'm going to use this example to illustrate of using US ETFs. Okay, now we get into the specifics of it. Okay, now why US ETFs? So this is part of the investment thesis. So I'm just giving you an example. I'm just running through you the thought process of building an investment thesis that you can actually use to make your own investment thesis. So this is an example I'm giving. So why US ETF? So what is my investment thesis for this? So number one, it's that if you look at the top 50 most valuable companies in the world, so this is not just in the US, but actually the top companies in the world. And these colors actually represents the different sectors. So the blue, it's information technology, energy. The green is their financials. With orange, it's consumer discretionary services. What you can notice is that all these brands that you can see, right, definitely you'll pick a couple of them that you're familiar with. They are all listed in the US stock market. I'll say not all, most of them, a majority of them actually listed in the US stock market. You have your usual suspects like Microsoft, Nvidia, Visa, Apple in the tech, Alphabet, Meta, Amazon, Tesla, McDonald's, right? And the banks, JP Morgan, Bank of America. So the investment thesis here is that the top 50 most valuable companies in the world are actually listed in the US market. So it means is that why? Another thing is that the market that the US companies are serving are not only domestically for US consumers, but also international markets. So definitely all of us in our daily life, day-to-day life, definitely we are using any of these products. Even today, you might have waken up today, open up your iPhone, or you're using an Android, then that's Alphabet, and then you've gotten your breakfast or lunch at McD, or maybe you've gotten the new Tesla that's here. It's for sale. So indirectly, and you're sending messages on WhatsApp, and even you're watching this on Zoom. So all these companies are actually listed in the US, but we are in Malaysia and we're using US listed products that's listed in the US. And at the same time, when we see that emerging markets are coming up, right? So now we see that India is coming up, like Vietnam or Indonesia, other emerging markets are coming up. So when people become more affluent, then they tend to get traction towards branded products, attracted branded products. So more people might shift to actually branded products they perceive to be branded in their mind, like Apple. So we have seen this happening, what happened in China. And China was going through the economic boom the past 10 years, and we have seen that this has helped the US companies to actually grow at the same time. Okay, so when the emerging markets also come up, it also indirectly helps the growth of the US listed companies. So that's my number one investment thesis. My second investment thesis is that the US market, in this example, S&P 500 has gone through over the years ups and downs. But if you see the overall trend, it's actually a growth of up. So there have been recessions. The most recent would have been the 2008 and also the COVID crash. But as a whole, the market has been always going up, and due to a few reasons, including inflation and also the growth of companies, and also having more technology companies that's actually improving productivity and growth. And my next investment thesis is that the S&P 500 in this example, right? It's through natural selection. So natural selection, it's from biology, it's from Darwinian theory. It's where it says that it postulates the survival of the fittest. Okay, so on the right-hand side here, you can see that in 2001, these are the top companies on the S&P 500. So you have your General Electric, Microsoft, ExxonMobil, Pfizer, Citi, and all that. But down the years, in 2021, 20 years later, that entire list is totally different, right? So that in gray, it's repeating. So Microsoft is still there. J&J, Johnson & Johnson, Walmart, they're still there. But the list is completely different of what it was 20 years down the road. So indirectly, the best and top companies in their particular sector actually get to be on the list by themselves. So now I don't have to actually analyze every 6 months or every year to see which company does well now and which company does not do well, and do that analysis to buy and sell stocks. I'll just invest in the S&P 500 and let the natural selection to do its work. So I'm just passively letting the market decide who's the best among them. Right? And lastly is that that my investment thesis is that it's for the very long term. Will I be okay that I'll just put in my money? I'm not just let the market do what it does. It's going to be up and down. There's recession or recession, and just be with it. And after 10 years, I'm just going to open up and see that, okay, investment's doing well. So based on my investment thesis, and this is why I'll pick US ETFs. Now, having said that, how do I actually structure my ETF portfolio? This is actually based on our FSM1 focus list. This is just a suggestion that you can follow. You can actually structure it in 3 parts by having 3 ETFs. One that focuses on core ETF, a growth ETF, and a quality ETF. So for core ETF, you could actually consider the VOO, the S&P 500, that tracks the S&P 500. For growth, the FTEC, which consists of technology stocks, and also the quality ETF will be the JQA, which consists of mostly blue chip companies that is selected based on their profitability, earnings, and solvency. Means that by having this, so I have the core that's kind of tracks the broad market, the quality, it's kind of like a buffer, and also to enjoy the growth, which also comes with volatility of the tech sectors. So I'm kind of like balancing it. So again, this is how you can actually do it, like just putting it there. And then how this portfolio have been performing for the past 5 years is that this is if you have invested just in the S&P 500, that is an analyse of 10.14, and the famous QQQ, which is the Nasdaq 100, that's 14.1, and the portfolio that's suggested, it's 13.56. But even though it has a slightly lower returns compared to VO and QQQ, but you can see that the drawdown, that means during the worst years, the drawdown, this portfolio does better, resulting in a better Sharpe ratio. So also the question that you need to ask yourself is that, yeah, in hindsight, on paper, yeah, this gives you a better returns. But during the worst years, when the market is down 25%, are you able to stomach this negative in your portfolio? So we want to actually balance both the growth and also the drawdown of the portfolio to have a peace of mind on both sides, right? So that's what having this portfolio does. And so we are almost at the end of our presentation, whereby how can you actually get started with just 100 ringgit per month with this ETF? So this is where we have the solution for you today. So I'd like to introduce the FSM1 regular savings plan. By having a regular savings plan, it means is that you can just get started by investing in any of these ETFs with just 100 ringgit. And before we get into the technique, how you can actually do that, let me just quickly tell you why using an RSP means that regular saving plan method works better than just buying with lump sum of money. Let's say you have 10,000 and just dump into that portfolio. Because with a regular saving plan, it means that consistently every month, you're actually putting in a certain sum of money into that. Because in that sense, you are not actually trying to time the market. So now you might have thought that, okay, the market might have gone too high from October last year. Maybe you said, okay, let me just wait for a while to come down. By the time it comes down, and then we have the fear of like not taking action, and then it reverses back, and then you'll be like, oh, I should have done it earlier. So we actually take out these emotions of trying to time the market and just consistently invest a certain amount consistently every single month without actually waiting for the market. And the best part is that it's automated, because when it is automated, right? It's just like our KWSP. Month in, month out, you get your EPF money deducted, and you have seen your account actually grow over the years. So it's the same logic here. It's that when things are automated, it removes the emotions and helps you to stay disciplined, so that you actually set it up and let it run. Because what gets automated gets done. And by knowing this, why use RSP method with FSM1? Because you can actually invest in fractional shares. So to answer the questions of like, hey, just now you might have seen that one stock of VOO actually cost around $400. That's like 1,800 ringgit with the current exchange rate. But now by buying less than a unit of less than a share of VOO, which is called fractional shares, just by using 100 ringgit, then you can get started. So it's easy for you to get started, even if you have smaller resources or smaller amount. And that's a low processing fee of just RM1 per transaction. And you have the flexibility of choosing the dates. You can do it 4 times on the first 8, 15, or 22nd of every month. You can just choose one date, or you can choose all the 4, up to you. And they are more than 100 ETFs that's listed in the US and Hong Kong stock market for you to choose from different categories and different types that we have gone through earlier. Okay, and there's no lock-in period. If you wish to sell it after a couple of months, then you are okay to do it, and you can also terminate that. So this is here to give you an example, right? Like earlier mentioned, there is one share of VO costs you $400, but now you can actually just buy 0.05 units of it with 100 ringgit. Just to illustrate based on past data, if you just start to invest 100 ringgit every month in VOO from 2010, October 2010, just 100 ringgit for the past 10 years, then that will be a return of 22,000. And that's a gain of around 10,000, which is around 89% or 11% annualized. So just by setting this once and just letting it run. So that's how powerful is the RSP. And today, I'm almost at the end of my presentation, is that in the month of September, you can actually enjoy 0% of processing fees. Remember earlier, the processing fee was 1 ringgit per transaction, right? Now we have taken that off, and it's 0% processing fee if you create an ETF contract, RSP contract, between 1st and 30th September. And you can enjoy this 0% processing fee until end of December 2024. Okay, so how to get started? If you already have an FSM1 account, this is how you could actually structure it. So every time that you get your salary or you have your savings, right, you can actually make a standing instruction to make an RSP monthly to the FSM1 cash account. So as FSM1 cash account currently gives 2.25% return, and then set another RSP monthly on the 22nd of every month to your ETF portfolio that you created. So once you have created this, every month, it is just automatically that the money actually gets debited from your salary account to the cash account and then to the ETF portfolio, and the entire process is automated. You just need to set it up once and just let it run and let your account grow by that. And then every 6 months to 1 year, you can actually view and analyze your performance of your portfolio and rebalance it. So almost I'm done on that session. So any questions you can actually type in the Q&A session, and let me just quickly take a sip of water and get to the questions. Okay, can I share the presentation through email revision for reference? Yeah, you can actually watch this presentation on our YouTube page. We'll be uploading it there. Recorded, yes, will be recorded. You can actually check out the FSM1 Malaysia page for this. Do FSM1 provide ETF dividend reinvestment feature? No, currently we don't have the reinvestment feature for ETF. Does ETF pay dividend or merely capital gains? ETF does pay dividends. It is both. Not all ETFs pay dividends. Most ETF, they do pay dividends. We don't have this feature at this moment. It will credit to the cash account. Depends on the ETF itself. Okay, US withholding tax. Okay, this is a very common, famous question, is that the 30% US withholding tax on dividends. It's that when a dividend is declared, 30% of it goes to tax. So after deducting the 30%, the balance will be actually distributed to us as investors. So the dividend that you get in your cash account when the dividend is being declared, it's after deducting the 30% of withholding tax. Can EPF invest in ETF? No, EPF does not allow us to invest in ETFs currently. Only EPF approved unit trust. Okay, for Muslims, how can we control for only Sharia compliance to cash account Sharia compliance? Yes, that currently we do not have cash account that's Sharia compliant. that has been also a frequent request from our investors. That has been feedback that they've taken into account for on the cash account. But we do have ETFs that actually tracks the Sharia indexes. So there it's the HLAL ETF, UMMA, UMMA, and SPUS. So these are some of the examples of ETFs that tracks a Sharia index. Okay. If I buy RM100 monthly, how many ETFs units am I actually buying? Those ETFs traded in US, right? Correct. Yes, all these ETFs are actually in ringgit. So when you actually, let's say, purchase 500 ringgit worth of ETF, because minimum is 100 ringgit. So it depends on the exchange rate on that particular day. We will actually exchange it, and based on that amount, then you'll get the fractional units. So you will actually see that in your holdings once the transaction is being settled. Tax, will I be taxed for buying VO fund? The tax will be actually only on the dividend, the withholding tax. As the buyer sellers are not very active transaction with LCIs, the ETFs to February index. Of course, yes, actually the volume would not, because there are actually market makers for ETFs. What will be more important to consider when you're investing like into KLCI index, right? It's more of going back to the investment thesis, right? The thought process of having that investment thesis. Again, ETF is actually an instrument that you're using to achieve your goal, and also based on your investment thesis, you're picking an ETF. So let's say, for example, that you are interested in hedging your account with gold, but you don't want to buy physical gold, then you just want to buy the ETF that tracks the gold price. Then you can actually, there is an ETF that is listed on Bursa that tracks the gold price, the price of gold. Can you help me? What's the closure of ETF? Okay, closure of ETFs, it's just like closure of any funds. If they are there are not much of volume or asset under management for that particular ETFs, the fund manager might decide to close down that ETF. Can you explain more on spread? Spread is the difference between the buying price and selling price. So if the volume is low, then the ask price, the bid and ask price will be higher. So then the price spread will be bigger. But that should not be a factor, too much of a factor to consider if you're actually investing for a long term. That is more if you're actually trading that particular ETF. Is it more fee will be charged using our method to invest in weekly? Yes, you're right. The fees will be more if you're actually investing weekly, and that is why I suggested this method, where you can actually, let's say you are investing in those 3 ETFs, right? So that's 100, 100, 100 each. So that's 300. So make a standing instruction from your savings or salary account to your cash account of 300, and then just do a monthly RSP on the 22nd. So you just get charged once instead of you doing it 3 times. So it's like also going back to how do you want to structure it. So to save on the charges, right? It's better that you accumulate the money in the cash account and do that transaction once. Okay, is RM1 processing fee US ETF? Yes. Currently for this month, the processing fee, it's not for US ETF, it's for RSP. If you're just buying outright a US ETF, then it follows the $3.80 of a minimum of 0.08%. The 1 ringgit processing fee, it's for ETF RSP only. So what are the ETFs that is in the RSP list? Then I'll quickly show you in a while. There are 103 ETFs that is part of the list in the RSP list. And for this month, then there's no processing fee. It's only 0% processing fee for this. Yes, other than the processing fees, there will be stamp duty and exchange fees, and that details you can actually see on our fees page. What are the various ETF rebalance? What are the various ETF rebalance? Okay, rebalance, like rebalance in the sense is that, for example, the percentage of how there was 33% in the growth core, 34 and 33 in quality, right? So for example, let's say the growth part grows up to 45%. So by rebalancing is that you might want to decide of maybe either lowering the amount, let's say you're actually putting in like 300 per month. So instead of 300, you actually lower it to 100, and the additional 200, you actually put it into other portfolio, which has the lower percentage, or you can actually sell off the balance percentage to then make it back into 33%, and the additional amount you actually invest it back into the other two other two ETFs that has a smaller allocation. So make it back into 33, 33, 34. I understand we should do opaque or sunshine trading. How do you understand this? Okay, let me answer that. What about just commodity? Does it work similarly? So for commodities, the ETF and commodities is that it's either they buy fit, they depends on the types of ETFs. Again, you can actually go and check on the methodology. You can use the resources that I've shown earlier, right? How they actually track it. For example, the gold, do they actually buy physical gold and keep it and store it, or do they just buy, do they just track by using other products or other leverage products or futures contracts in that sense? So different ETFs behaves differently. So the best way is to actually look at their underlying methodology of how they actually decide to track that particular ETF for that particular commodity. SPY, SPLG tracks S&P 500. What's the difference between these two? One is that service provider. They basically do the same thing, but the way they do it will be different. SPY has been actually, that's the very first ETF, so they have been in the market the oldest. And usually, SPY, I think SPY's expense ratio also is a bit slightly higher. And mostly traders use SPY because of the higher asset management, under management, also the higher volume of it. So it works more for traders. So besides that, yeah, they basically track the same index. And there are some ETFs that actually also the way they track will be different. For example, do they track it equal weighted or market cap weighted? For example, if that one NVIDIA or Apple has like certain percentage, do they follow that certain percentage, or do they just allocate the same percentage to all the stocks that's under that particular index? So that information, again, you can actually find in the fact sheet. So our goal here today is that for you to, again, as the name suggests, right, it's an education series. What we hope is that after today, you will be more informed to do the research, your own research. And while on that topic also, I'll also quickly share that how you can actually do that on our website, where you can actually, okay, this is the FSM1 website, and we have the ETF over here. So you can go to Get Started, Regular Savings Plan, click on that, and then there's just a brief introduction of what is RSP. Then go to RSP list down here, and then that's the ETF. And you can see that these are the all 103 ETFs. So you can actually sort it by name, dividend paying or not, focus list or region. That's the focus list. So the focus list is that, what it means by focus list is that these are the ETF that is recommended by FSM1 from our research team. And you can actually also go to ETFs, research over here, ETFs, research, focus list. And these are all the ETFs. For example, the VanEck Semiconductor ETF, when you click on it, and again, so the informations are there. So how does it track? And another thing that's you can do is that by reading the research article. So you go to ETFs, research ideas. So there are many research articles that's being prepared by a research team for you to get an idea, to get a more understanding of the ETFs that you want to research on. So let's say you're actually interested in the semiconductor, right? So you can just use this search tool over here and say that semiconductor, I can spell it right, semiconductor. And over here, go to articles, and under that you can actually like check out all the related articles to that particular industry for you to make better decisions on that. So there is this, there was a recent stock split. So that's a detail there. Okay, I'll just answer a couple of more questions. RM100 fractional shares equivalent. Yeah, correct. So that will be, this is based on the earlier example, right? This was, I think, a month ago, that's 0.05 unit. But when you actually purchase it, when you do the transaction, then you will actually get in your statement, in your holdings, that you will know that the exact units that you get. But what's more important here is that I like to emphasize here, it's that to make use of the 0% processing fee. But before that is that to come up with your investment thesis, to come up with your portfolio, and to get started of building your investment. Yeah. Okay, so that, I think I've answered most of it. So are there any more questions that you have? Oh yeah, that's one. What's Sortino ratio? Okay. Sortino ratio, it's actually similar to, okay, the purpose of it is actually also to see the risk reward of a portfolio. Let me go back. That was earlier, right? Okay, this one. So it's actually it's a modification of the Sharpe ratio, and again, the number, how do you see it's that the higher the better. So the risk adjusted risk return, it's that like, okay, the return that you get, but what is the risk that you're actually taking. So for the Sharpe ratio, it's that it gives you the volatility of the upside and also the downside. But then Sortino ratio only gives you the it penalizes on the downside, means that it then only. Okay. Yeah. So what you can see here is that it's not only to actually look at the returns as returns itself, but also look at the worst years and also the drawdown, means like what are the risks that you actually taking to actually get the return. So this ratio actually kind of like gives you an idea of that is it worthy, is the investment returns, is it worth it, depends on the risk that you're taking it. So an easier way to actually look at it is that to look at the ratios, and how to read the number, it's that the higher that the number is, then the better is it to that. What is a managed portfolio? Okay, managed portfolio, it's actually managed portfolio. It's another product that we have that it's actually a portfolio of unit trusts that is managed by our portfolio managers, in-house portfolio managers. Yeah, what's the currency conversion rate based on the rate published on the cash account? The currency conversion rate, yeah, actually you can actually go into the cash account and see for yourself it's a live rate. It refreshes often, and you can actually open up your bank rates and just have a comparison side by side, and you can get an idea whether that trade is okay for you or not. So that is for the cash account. Okay, so fact sheet. Okay, just the last few questions. Fact sheet is that, okay, you just have to search for that particular ETF. Okay, let me stop there. You just need to search for that particular ETF, and I can show you that. Okay, so use this. Either you can actually just go to ETFs, regular saving plans, and go to the RSP list. Okay, go to ETF, let's say core equity, or you just want to search, you already know what's the ticker symbol, so you click on it, and it will bring you to that fact sheet. That you can just look at all the different information that's there. Or if you know what is the ticker symbol of that, you can also search the ETF by just typing in the ticker symbol. And so you can see it's ETF, right? So you can just click on that, and then it brings you to that. But remember, these are some of the ETFs are actually not under the ETF RSP. So if you're looking to use the ETF RSP method, then the best way is to just look at the list here. So these are the list that you can. So it's easy to just use this list. And if you're like totally new and not sure, you can actually use the focus list as a guideline for you to actually select those ETFs. So the 3 ETFs just now, the JQA, VOO, and FTEC, are from the focus list that we have. So I've selected it based on this. But besides that, there are also other different ETFs. So also going back to your investment thesis, you can select it based on this. Okay. So this is done. Is the currency conversion rate based on? Okay. Yes, the currency conversion rate is based on the rate published under the cash account. Yes, that is. How do we take advantage? How interest rate will use in our investment? Well, how do we take advantage? In this sense that because now when you're investing in by using ringgit and you're actually buying the dollars, right? So you actually when the interest rate actually increases, then if the ringgit drops, then you have the currency gains. But at the same time that when the US dollar drops and the ringgit also stays at the same, then you might have also drop in your the value that you bought earlier with the higher US dollars. But again, if you're actually doing it RSP monthly, then you're just averaging down your costs. So that's fine. So I wouldn't say that will be actually a main concern if you're just looking at it in the longer term. But that interest rate, it's more applicable if you're looking into investing in bonds. That will be a better interest rate. It's a more important factor if you're actually looking in bond investments. And those topics are covered earlier. You can actually check on our YouTube website when we covered about bonds. All right. So thank you so much. Just around 10 minutes of time, but I do hope that you had a good learning. You learned something new, and those, if you have already are familiar with ETFs, you actually gain some additional knowledge, and hope you could actually make use of the promotion that we are having now, only currently for this month, on the 0% processing fee. And what I would like to, just a last takeaway that I would like to share, is that a quote from Peter Lynch, so one of the top investors, is that far more money has been lost by investors preparing for corrections, meaning that far more money has been lost by investors doing nothing compared to actually being lost in the corrections itself. Means that there is no actually best time or better time to invest. So there is an opportunity now with this promotion. So get started investing, have your investment thesis, formulate that, come up with your portfolio, and put in the start putting in as low as 100 ringgit, and you're on to go, automated. All right. So with that, thank you, everyone. Thank you for spending your evening today. And I hope that it benefited. You had learned a thing or two. And if you have more questions, feel free to actually drop us an email at investhelp.my@fundsupermart. And we are more than happy to answer your questions, or you can actually, depends on which location you are, you can just give us a call. If you like to know more, or if you're not sure of certain things that we have covered today, and we are more than happy to actually help you and to clarify your doubts. Okay. And with that, okay, I'll just take one last question. Is that, yes, the promotion is until end of December 2022. Okay. Thank you, right? Thanks, everyone. Have a good evening. Take care, right? Bye-bye.